Looking at the Bain Investments Company problem set here, this is going to be focused on ethics. As always, let's scroll down to the question and we'll read that first question here, and then we'll get started on reading and figuring out that answer. Question 1. By issuing a report recommending that investors purchase SOS stock, has Hendricks most likely violated the standards? We've got no, yes, or yes, and then the two yeses are related to different reasons for violating. So let's go back up to the top and we will start reading until we have enough information for that answer. Bain Investments Company is a mid-sized investment firm that has adopted the CFA Institute's Code of Ethics and Standards of Professional Conduct, but does not currently claim compliance with Global Investment Performance Standards, or GIPS. Several of Bain's employees are CFA charter holders or candidates registered to write CFA exams. Jacqueline Hendricks, that's the character we're looking at, one of Bain's equity analysts and a Level III candidate in the CFA program, notes that she recently promised representatives of a prospective investment banking client that she would provide full research coverage of its stock if they agreed to have Bain underwrite their forthcoming IPO. Hendricks later shares that she felt uncomfortable when she was asked by her supervisor, Bain's director of research, to issue an updated recommendation on shares of Sheffield Oil Services, SOS. So that's, I believe that's what we were looking at here. So we had SOS stock, and so it looks like we're going to be getting to that information we're looking for here, which she has covered for several years. SOS recently reported quarterly earnings that fell below most analyst estimates, including Hendricks's. After analyzing the most current information over 2 days, Hendricks concluded that the market had overreacted to this negative news and the company's shares were trading at a price below their intrinsic value. She issued a revised report on SOS stock that included a buy recommendation. Bain's dealers later sold clients some of the SOS shares the firm had been holding as inventory. Bain's Chief Compliance Officer, Emily Chowda, CFA, calls a meeting with staff to outline the importance of proper communication with prospective clients. Chowda opens the discussion by asking participants to share their recent experiences. Leslie Barnhill, an analyst in CFA in the CFA program, makes the following statement. So it seems like we've gotten all the information we need to so far. The main thing here is Hendricks is putting out a new report on SOS at the direction of her supervisor. So by issuing a report recommending that investors purchase SOS stock, has Hendricks most likely violated the standards? So a couple key things here. They reported earnings below most analysts' estimates, including Hendricks's, but after analyzing the most current information over 2 days, so this would indicate that she's doing her proper due diligence and analysis, she concluded that the market had overreacted to this negative news and the company's shares were trading below intrinsic value. So it seems like she did good due diligence here, and there's no indication of there being any conflict of interest between the Sheffield Oil Services. It mentions that they promised a prospective investment banking client they would provide full research coverage, but it doesn't say that it was Sheffield Oil Services, so that's probably kind of just thrown in there to throw you off. So based on the information we have, I'm going to say no, we did not violate the standards. So yes, with respect to independence and objectivity, like we said, there's nothing there that's kind of creating a conflict of interest that would break our independence and objectivity. And she certainly did a lot of diligence and reasonable basis. It wasn't some rash decision to throw this report out there. So we'll go with answer A, no violation. Question 2, is Barnhill's statement about investment returns most likely consistent with the standards? So we've got yes, because she doesn't guarantee a specific return. No, it violates the statement, violates the standards concerning misrepresentation. Or C, no, the statement violates the standards with respect to additional compensation arrangements. So we left off right here, which it looks like that's this may be the sentence we're looking for. Leslie Barnhill, an analyst and level 1 candidate in the CFA program, makes the following statement. While I point out to clients that they will not lose money if they remain invested in equities for the long run, I never guarantee a specific return. So this, right off the bat, looks like it's going to be a big no-no. Even though they're not guaranteeing a specific return, you can't. They're guaranteeing that they won't lose money, which we certainly can't do. So this is most likely going to be a violation. So let's take a look back at these answers. Is the statement consistent with standards? Yes. We're gonna cross that off right away. So now we just need to decide between these two answers and why she violated. So violating standards concerning misrepresentation. This is certainly a misrepresentation. So this could be our answer. And then C, violates with respect to additional compensation arrangements. It doesn't say anything about Barnhill's compensation being hinging on this specific return that not saying that they won't lose money. So I think we can confidently go with answer B, violating the standard of misrepresentation. Question 3. By not disclosing the nature of her compensation arrangement to current and prospective clients, has Hendricks most likely violated the standards? So we're going to be looking at compensation arrangement, and we're going back to Hendricks from Barnhill. So we've got no or yes with respect to disclosure of conflicts, or yes with respect to loyalty, prudence, and care. So we left off at this last statement, so we'll start here. Hendricks reveals that she receives part of her compensation. Okay, this might be the information we need right here, in the form of a quarterly performance bonus based on the accuracy of her recommendations, and that she has never disclosed the nature of this arrangement to current or prospective clients. Barnhill mentions, so it looks like that's all we're going off of right here. So has Hendricks most likely violated the standards by not disclosing this compensation arrangement? So we've got no, yes, or yes. So this is a little tricky here because we generally do want to disclose performance bonuses, but typically this is going to be we want to disclose it when it's based on some type of return target that an analyst or portfolio manager might need to hit, and because of that, because they have a return target, this could potentially have an effect on how they manage the portfolio, which is certainly a material thing to know for a client. However, this is based on the accuracy of her recommendations as an analyst, and there's not really any conflict of interest there or reasoning that she would want her recommendations to not be accurate. Everyone would want her recommendations to be accurate. And so there's not a need to disclose the compensation arrangement for this. So we can go with answer A, no. Question 4, if Barnhill presents the slide summarizing the 5-year returns of the model portfolio as it currently appears, will she have most likely violated standard 3D performance presentation? So we left off right here from that last question, and we're picking up with Barnhill, so let's start reading. Barnhill mentions that she recently gave a presentation to prospective clients using materials that the company's public relations department had prepared. Among the materials she discussed in this presentation was a slide with a graph showing the returns of Bain's Composite over the past 4 years. This is 4 years. We're looking for 5-year returns here, so I don't think this information is relevant yet. Before giving the presentation, Barnhill noticed that the slide in question used to return data for years 1 and 2 on the 10 accounts that were included in the composite at that time. At the end of year 2, one of these accounts was terminated, and the return data presented for years 3 and 4 were based on the performance of 9 accounts that remained in the composite for the entire period. The change in the deposit was disclosed in a footnote at the bottom of the slide. Barnhill revealed that she reviewed the slide before giving her presentation and used it after deciding that no changes were necessary. Looks like we don't have our information yet, so we'll keep reading. Barnhill also notes that she is preparing a separate presentation for prospective clients that includes a section that summarizes the performance that a model portfolio would have achieved on a gross of fees basis over the past 5 years. That looks like what we're looking for. If it had been managed following her proposed strategy. The fact that these gross of fees returns are simulated is disclosed, that's important, in a footnote at the bottom of the slide. So basically, Barnhill is presenting this portfolio to prospective clients that they weren't actually managing, but it's a back test, and so it's showing the returns of that proposed strategy, which is okay to do as long as it's disclosed. So let's take a look at the question again and the answers. If she presents the slide summarizing the 5-year returns of the model portfolio as it currently appears, will she have most likely violated standard 3D performance presentation? So we've got no, yes, by presenting simulated returns. You are allowed to present simulated returns, but like we've already mentioned, you just need to disclose it, which she clearly does. And yes, by presenting gross of fee returns. You can do gross of fee returns as well, but same thing as B. You just have to disclose it. And so that's going to leave us with answer A, no violation.